Okay, today I wanted to talk about the Brandeaux Funds. They recently closed to any new investment and they stopped any redemptions. So I wanted to have a little think about what that meant for these funds and the alternative investment market. The Brandeaux Funds were mostly focused on student property. They had two funds, a ground rent fund and the student property fund. And the student property fund had about £1 billion in assets, but on the 1st of July this year they closed to any new investment, and they also closed any redemptions, so investors couldn't get their money out. And the chief executive, he actually said that there was no need for investors to panic. The funds were still performing well, but the difficulty was around liquidity and having enough liquidity to pay investors if they wanted to leave the funds. So I just wanted to focus in on a couple of issues to do with that: liquidity, regulation, and the importance of independent valuations. So thinking about liquidity for a moment, how do you get liquidity within a fund? Well, one way would be have a huge pile of cash, and then any time an investor wanted to exit, you could give them the value of their investment out of that pile of cash. That's not going to work in reality because it's just much too inefficient. You'd have such a huge cash drag on the performance of the portfolio that it wouldn't be worth running it that way, so the investment wouldn't be worthwhile. So that option's out. The other option is to sell the assets that are within the fund. So if someone wants to withdraw their money from the fund, you sell the assets, and the money you raise from that sale you use to pay the investor back. That works with liquid assets, of course, something like stocks and shares that can be traded daily, but with property it's much less liquid, and so of course that's much harder to do. The other way of creating liquidity is to match buyers and sellers, and that is usually the way property funds work. They match buyers and sellers in some way. So how can you match buyers and sellers? Well, there's two ways of doing it. You can have a closed-ended fund. So once you've done your initial fundraising, you issue shares to all of the initial investors, and then that's it. The shares can be bought and sold on a secondary market, so buyers and sellers are matched that way, but you don't create any more shares or reduce the amount of shares in the market. It's up to buyers and sellers of those shares to set what they think is a fair price. So that does create liquidity, and that's obviously how a lot of companies trade, and a lot of closed-ended funds trade, by buying and selling the shares, often on a stock exchange. So you've got daily liquidity. We seem to have a bit of a fetish for liquidity. We think it solves a lot of problems because it means if things start going wrong, you can exit the investment. And you know, the regulator, for example, has a strong preference for liquidity, particularly for ordinary retail investors, because you know, the liquidity does give them an exit. But we shouldn't get too carried away with liquidity. Just because you can get out, it isn't going to save the day if things start going wrong, because if the value of the fund is falling, if the investment is performing poorly, yes, you might be able to sell your stake on a stock exchange, but you're not going to get anything like the price that you want for it. So we shouldn't get too fixated on the idea of liquidity as solving all of these problems. Yes, it's liquid, but if you don't get out in time and the price drops through the floor, then it makes no difference. You're still going to make a huge loss. The other way of creating liquidity is to have an open-ended fund where you just simply match buyers and sellers, and maybe you have it unitized, and you create new units for new buyers, and then they redeem those units when they exit. It's a little bit difficult to understand, or from my perspective I think it's a little difficult to understand why you'd have an open-ended fund that was invested in illiquid assets like property, which is what we had with the Brandeaux funds, because that always means there's going to be the possibility that if you can no longer match buyers and sellers, you can't create and redeem units, and you can't sell the underlying assets because, as we've said, they're already illiquid, they're properties, so you know, transactions take a long time. So that does give you this possibility that if you can't continually match buyers and sellers, you're going to have some sort of liquidity problem, which is what hit Brandeaux earlier this year. So it's important to explain to clients exactly what the problems with liquidity mean. Just because something's liquid doesn't mean they're going to be able to get out at a fair price, and just because something is liquid one day, it doesn't mean it's going to be liquid the next. That liquidity can dry up at a later date. So clients really need to understand liquidity risk if you're going to put them in these kind of investments. It's an important thing that I have a feeling that a lot of clients will say yes, they understand it, but actually it's worth exploring to make sure that they really do get the concepts that are behind it. I said as well I wanted to speak about valuations and the importance of an independent valuation. The difficulty is if you have a scheme operator carrying out their own valuation of the assets within a fund, they could have an overly optimistic valuation. If they weren't very ethical, they could have a deliberately overly optimistic valuation of the assets within a fund. And that would give a misleading impression to investors, obviously. And the liquidity could come from matching buyers and sellers. They may even pay returns out of new money invested, which is essentially a Ponzi scheme. So the best way to verify that you're not placing money into a Ponzi is to have an independent valuation of the assets within that fund. Then the scheme operator can't get away with any kind of funny business. You know that there is value in that fund, and that's where the returns are coming from. Okay, the final point I wanted to make, or lesson I wanted to draw from the Brandeaux situation, was to do with regulation. Brandeaux actually said that one of the reasons they had to close to new investments and stop any redemptions was because of the new regulations, PS 13.3, which means that the regulations around the sale and promotion of UCIS funds, unregulated collective investment schemes, are much tighter. And what Brandeaux was saying is because of these new regulations, the market for new investments has dried up. IFAs are staying away from putting clients into these funds, and that is what caused the liquidity problems. So that would be an unforeseen consequence of the new regulations, and quite an unfortunate one really. If the funds are performing well, it means that the current investors are now locked in there. They can't redeem the value of their investments through no fault of their own. It's simply because of the regulations. And it also means that potential investors can't access these funds, again because the regulations have led to this this action by Brandeaux. Now, I think in reality the regulator, the Financial Conduct Authority, will probably just take this on the chin. They'll think that yes, it's an unintended consequence and maybe it is unfortunate, but it's probably a price worth paying to implement this policy and keep retail investors out of UCIS and closed substitutes and illiquid schemes. But it's kind of a demonstration of how you can get some risks that just are very hard to predict, like a change in regulations suddenly means there's no liquidity in the fund that you're invested in, suddenly means that that fund closes to redemptions and you find you're stuck in it. So it's a difficult one to get right, and it's a very difficult risk to predict. So it just shows how tricky these things can be, particularly in a sector like the UCIS sector, which is under close scrutiny from the FCA at the moment. Here at Intelligent Partnership, we have a very good, broad understanding of the alternative investment market, and we cover it in some detail. So if that was useful, or if you want to find out more, or you want to learn anything else about any other aspects of the alternative investment market, just get in touch with us via our website.